You're about to hear my conversation with Dustin Reed, our chief fixed income strategist. We talk all about his reaction to the Fed and Bank of Canada decisions on interest rates today. I hope you enjoy. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to Market Exchange from Mackenzie Investments. My name is Matthew Schnurr, and I'm delighted to be back with our chief fixed income strategist, Dustin Reed. Dustin, welcome back.
Matt, great to be back with you.
We time these podcasts always on the decision days, and today we have two decisions, both out of the Fed and Bank of Canada. Love to start with the Fed. First of all, summarize what happened. We saw the 25 basis point cut, but give us more details on that, and then any other comments that you want to dive into.
For sure, yeah, absolutely. So absolutely, the Fed did cut by 25 today, which was very broadly expected. When I looked this morning around 8 o'clock, it was literally fully priced at 25 basis points. So sometimes you go in really fully priced, and sometimes it's close, like to 22 or 23, but this time it was fully priced. The statement was interesting. There were parts of the statement, particularly one sentence that talked about risk to the labor market that I would actually view as a little bit bearish or a little bit dovish, maybe a little bit more concerns around that side, but that got negated later in the press conference, which I'll talk about in a sec. And the Fed, obviously, in addition to cutting by 25, effectively said it's going to stop its quantitative tightening program. And I always like to say this for those that aren't watching it as closely. So most people know quantitative easing, which is generally when you're buying bonds, so your prices are higher, yields lower.
Right.
You're adding liquidity to the balance sheet, and you're causing yields lower, which means, in theory, the credit transmission mechanism is easier. So the Fed's been doing a quantitative tightening program, QT program, for the last a number of quarters. And so that's had the kind of the opposite effect. But as the Fed has obviously started to cut rates or re-engaging to start cutting rates again here, it's a little bit, and we've talked about this analogy, foot on the gas, foot on the brake at the same time, right? You're cutting rates,
Sure.
but you're also running QT programs. So the Fed's announced that it's going to stop its QT program. There was a bit of a market whether they were going to announce it today or they were going to announce it in December. They announced it today, although they kind of took the middle road, and instead of saying we're going to stop it, today or Friday or November 3rd, I guess, which is the first business day of November. They actually said December the 1st. So they're going to let it run a little bit longer, but that's really just semantics, I think, at this point. Now, also interesting, I think, in the statement, we had a bit of a three-way decision, which we really rarely see in the U.S. It's very Bank of England-like, which kind of happens once in a while. And so what I mean by that is the majority voted for a 25 basis point cut, right, which we know. The new governor, Moran, again voted for 50, so staying stable, 50 basis point cut, to be fair. So he remained consistent with his view back from September when he joined the board, basically the day of the September FOMC meeting. And then we had one voter actually say, I'd rather not cut rates at all. So you had somebody who voted zero, no cut. And I'm not surprised. That was the Kansas City Fed president, and he's quite hawkish. So you had a three-way decision come down and two dissents, as it were. And that's quite interesting. I mean, even any dissents really are somewhat interesting in the Fed, but having kind of a three-way decision there is maybe a little bit more interesting. It's the third meeting, I believe, in a row where there have been dissents. And traditionally, when you pare back and look at the whole history, it's you generally don't see governors dissent against the chair. So you can see that it's not acrimonious. I don't think it's acrimonious. I think it's a very tough time, I think, for the Fed and for all watchers and all strategists and economists, because you've got a labor market that probably says rates should go one way, maybe lower, and you've got an inflation outlook and I think 55 or 56 months with headline inflation now at 3% or above, which would argue if you want to get back to your 2% target, then your policy rate, your Fed funds rate, maybe should go the other way, higher. So what do? You can't do both per se. So I think that makes for a great debate around the table. And, I can only talk really about the conversations I have with, people in Toronto and New York and around the world on what people think. And there's a market, and around the table that I sit at, every day, every week, around our team table and what what the different views are. And so we have those discussions, and I'm sure, more than sure, because it's in the statement that the Fed is also having those discussions. Maybe switching to the press conference quickly. So I think the market maybe initially took, despite what I said on the change in the labor market tone from the official statement a minute ago, the market took the dissent by the Casey Fed president as a bit hawkish, and you saw the dollar a little bit bid and rates a little bit, well, at least fixed income a little bit offered, so prices lower, yields higher. But then Powell during the press conference, and this is probably the real highlight of the afternoon, really push back on the idea of a December cut. But generally, the placeholder answer is, well, we don't pre-make decisions on the next meeting, and that's generally the placeholder answer. And he gave that answer, but then he actually went out of his way to say something to the effect of, I don't have the transcript in front of me, but something to the effect of, but this time, and he actually said, I know I always say this. So he actually acknowledged it, kind of a little bit tongue in cheek. And then he went beyond and said, but actually this time we really don't know. And I think part of that is because of the government shutdown and the lack of some official top tier data, particularly the non-farm payrolls report, I would suspect,
Right.
and the risks around inflation, CPI data going forward. So he really seemed to put a lot of emphasis on that more so than usual. It wasn't the usual semi-casual throwaway comment. And markets took that very seriously because the market was, if I remember correctly, going into our 8 a.m. meeting this morning, we were 46 basis points priced cumulative for today, of which that was 25, and into December. So 46 basis points through the end of the year. If December is now, I mean, obviously 25 happened today, but if December is very much who knows, then that needs to get taken out significantly. So just before the podcast, I saw that number for December is now down to 17 basis points. And interestingly, using December 2026 as kind of as a flag in the ground as to what 2026 looks like, and we can talk about that a bit if you want. But going into my 8 a.m. meeting this morning, I believe it was around 114, 115, 115 basis points priced, and about half an hour ago, that number had dwindled to about 85, 86 basis points. About 30 basis points getting priced out here on the back of this decision for the next year and change, basically the next nine meetings. And those moves happen once in a while for sure, but they're not all the time. So the market's having a pretty significant reaction to this in terms of repricing the U.S. Treasury curve higher, and the U.S. dollar is bid. Very interesting kind of change in tone from Powell. I would not have expected Powell to, I wouldn't say shut the door, but clearly push back so hard against December pricing, particularly given where we were a month ago in September when they cut rates by 25. But it was a forecast meeting with a dot plot, and they had two additional cuts
Right.
priced in, or at least specced out at that time. And as you get closer to the end of the year, those cuts are, unless something odd happens, those cuts are a little more set in stone, right? It's easier to talk about what's going to happen in December in September than it is in March, because you have obviously more
Sure.
certainty because there's less runway ahead of you generally. So that, I think, has caused a lot of surprise and will be something that all market participants that are managing assets will be looking at for the next the next number of days for sure.
I guess maybe you can help me with something that I'm a bit confused on. So, totally understand the comments around the December and that Powell has put in some uncertainty on what seemed like a fairly near certain December cut. His term is up in May of next year. Is that right?
That is correct.
And Trump has made no no apologies about his dislike for Powell and the fact that he thinks that interest rates should be dramatically lower. He
Yes.
appointed Moran, who's calling for 50 basis point, or Moran was appointed. Presumably, the next Fed chair will have a Trumpy-like exposure. Why would the market sort of make a pretty dramatic correction on the 1 year interest rate trajectory?
It's a fantastic question. I think there's a few things going on. The first is there seems to be a short list emerging for Fed chair. There was an FT piece about 3 weeks ago that had it, the scoop, so to speak, in kind of journalistic terms. And then Treasury Secretary Bessent a couple days ago effectively confirmed it. there's a short list of 5 people, and it's the same list. So when the list came out from the FT 2 or 3 weeks ago, it was Hassett, who's part of the current administration. It was Waller, Governor Waller, Governor Bowman, Kevin Warsh, former Fed governor, but not currently on the board, and the CIO for fixed income at BlackRock, Rick Ryder. When I saw that list, and NFT scoop can be right, it can be wrong, who
Sure.
knows? But when I saw that list, I thought some of the kind of more taily concerns, at least that I would have had, are not totally mitigated, but significantly mitigated. Hassett, I think, could still really adopt, let's call it a Trump orthodoxy when it comes to rates.
Sure.
But even after the FT article and discussions that I had with people, some were saying, I think Kevin, I know Kevin, I don't know Kevin, but people I was speaking to, I know Kevin, and I think he's actually quite orthodox once he gets in there. So I think the market is a lot less concerned about kind of tail risk or like really odd risk than we were even a month or 2 months ago. And so I think that's most of it. I also think that, and maybe the second answer to the question is that, when the market's pricing something and the Fed does something that is not completely against it, but clearly pushing away from it, the market will adjust that very significantly. So I think that, and that's the initial reaction. Now that could get put back in over days or weeks for sure. And we'll see how the data evolves. But I think those are generally the two reasons why.
Fair enough. I want to touch on the government shutdown as well. You referenced that in the lack of the highest tier data. How much of the shutdown is playing through, do you think, for Fed decision making, both on the data side as well as just on impact to GDP as this prolongs, might get more substantial? What's your view just on the shutdown in general?
I think first of all, we're now into I think around the fourth week or so,
Hmm.
because I think it started October the 1st, and here we are recording on the 29th, so 4 weeks, I guess. It should be having an impact on the economy now. Kind of the general view is kind of after 2 or 3 weeks, it's worth zero point 0.1 or zero point 0.2 percentage points off real GDP growth per week. So I think it's probably already starting to hit a little bit, but we're kind of in the very, very early innings of that. Powell during the press conference today said, again, I don't have the transcript in front of me, but something along the lines of an analogy, which is, if you're driving in fog, you slow down. And he was alluding to the government shutdown and the lack of some of the top tier data, with respect to that comment. And so I think again that amplifies kind of the price action and some of the stuff that I mentioned a couple minutes ago. So I think that it is affecting the Fed and its ability to have confidence. And now Powell also said, we have other pieces of data and we have a general idea of the directionality. It's more around the amplitude. And as Powell said during the press conference, we can't get as the word he used, granular, which is a great word, which I use all the time. We can't get as granular on the economy and on the data as we normally would. And so I think that's kind of the thought process behind this. We're driving in fog. When you're driving in fog, you got to slow down. So I think that's where the Fed is at. I mean, clearly there are a lot of alternative data sources on labor market. ADP actually just yesterday said it was going to release publicly a weekly data series, which will help on the private payrolls side. You can still construct, and Powell mentioned this, you can still construct the initial jobless claims data, which is arguably one of the best pieces of data to get. It's effectively real time. It comes out weekly, generally on a Thursday. And even though the federal government isn't releasing it from a top down perspective, the states are still open and each state reports their initial jobless claims. So you can kind of go through the 50 states and bottom up the analysis, so to speak, and then put a seasonal factor on it and make an estimate. And when you do that, and a few of the big houses in the US are doing this, within an hour or so of when the data gets released on Thursday mornings, you kind of see that claims are still relatively stable in that 230-ish thousand neighborhood, seasonally adjusted, which is still a pretty strong labor market. But you can also look at the Adobe Digital side. You can look at the Indeed job opening side and just kind of see where things are at. And of course, we still get private stuff like the ISM data, both manufacturing and services data, the,
Right.
the regular monthly ADP data, those sorts of things. The CPI data will be tough to get. It looks like now. I mean, obviously, no one's been out collecting data in October. So the October data for CPI is I don't know what they're going to do. It's really never happened before in the 100 years or whatever it is since they've been collecting it, because a lot of things get benchmarked to CPI and they've never really missed a month. So, because the last time there was a large shutdown, BLS was still open, Bureau of Labor Services was still open. So this is kind of unprecedented. So the Fed, again, I think that's why Powell's kind of backing off and just say, hey, pricing, effectively 21 basis points for December before the meeting today, right? Like 25 plus 21, 46 going through the end of the year. Pricing 21, you didn't say it this explicitly, but pricing 21 is probably not the right number because we just don't know. And so I think it is having an impact, and it's challenging for those in the space, and the Fed's feeling the effects too.
Fair enough. Why don't we move to Bank of Canada? We also had a 25 basis point cut from the Bank of Canada today. Tell me some commentary about that. It was widely expected as well, but anything to take away?
Absolutely. The Bank Canada meeting this morning was well priced as well. Probably not quite as fully priced as the Fed meeting going into today, but still relatively fully priced. I think it was around 21 or 22 basis points in the bank. Obviously, cut by 25 to take rates to 2.25% for the Bank of Canada. So the first thing I would say is this is an important level for the Bank of Canada. The bank believes, from an academic perspective, that the neutral range of interest, overnight interest rate for the economy, Canadian economy, is somewhere between is a range somewhere between 2.25 on the bottom and 3.25 on the top. And again, with today's cut by 25 basis points, we went from 2.5 to 2.25. So we are now, at least according to the Bank of Canada's academic thought process and literature, at the bottom of the neutral range. So we're just hinging on accommodative, but not quite there. And I think that's very important in terms of the discussion. And maybe I'll get to that more of that in a sec. Still concerned about the tariff story. I think the bank's still concerned about the tariff story. Most people took the statement from the bank when it came out this morning as this is basically the end of the easing cycle for the bank. The language used, and the bank didn't talk about what I just talked about, kind of the neutral range, and we're at 2.25 and therefore nothing, or we're stopping. But the language that the bank used in the statement seemed to suggest and give the market an impression that the bank is going to be done for a little bit here if the economy evolves as it expects. Now, what's interesting about that, and it did say as if the economy evolves as it expects or anticipates, is that, I mean, sitting here obviously in the October meeting, the bank cut, and it's, as we say, a forecast meeting for the bank. So there's a little more detail around the outlook for the Bank of Canada as opposed to the October meeting for the Fed, which is not a forecast meeting. The bank cut its real GDP growth estimates for 2025 by zero point 0.6 percentage points, which is pretty significant. But we are late in the year, and maybe it's a bit mark to market. Q3
Sure.
so far hasn't looked great, although we don't have the final numbers yet. But we're sitting here in October 2025, and the bank marked down 2026 real GDP growth by zero point 0.7 percentage points. And that got my attention because it's pretty early to be marking down next year, at least by that much.
Right.
And so, kind of marry what I just said about the downgrades in GDP with if things evolve as we expect, then the impression is they didn't say that they're done, but the impression that they were giving or the bank was giving that it was done. And that doesn't really seem to line up too well, at least for me. It seems to suggest that the bank believes that there's some downside risk. I mean, maybe that's an obvious statement, but there's some downside risk to the economic picture for 2026, which is something you and I have talked about in the past, and it's been a long-held view of myself and the team here. And so I look at that, and I also think about what I said a few minutes ago around the range and the 325, and that we're now at 225. And if the bank is concerned about the outlook in 2026, I'm starting to think more about the Bank of Canada cutting below 225, which would be presumably 25 to, let's say, 2%, which would be, at least according to the bank, accommodative, or an accommodative overnight interest rate for the economy. And that's not necessarily a new thing. We've been thinking about this for a number of months, if not quarters, that the bank would need to go below 225, one, and two, more than the market currently and previously believed. And I think that is shaping up, even though the bank seems to be on hold here. And I don't expect now the bank to go, not that I did per se, but I don't expect the bank to cut in December, Bank of Canada cut in December. But I think a cut or two in the first half of 2026 seems reasonable if the economy, now I'll change it a bit, if the economy evolves as I anticipate that it will with respect to immigration or lack thereof, the housing market or mortgage market reset, how the unemployment rate and the labor market are going to evolve. And I think some lumpiness around, which again we've talked about before, but around the trade story, USMCA. I mean, which sounds a little more obvious today than given the 10% kind of back and forth after the commercial stuff from Premier Ford.
Sure.
But that's something we've been saying for a while is that we think USMCA will get there, but it's going to not be linear. It's going to take some back and forth. And that causes, I would say, C-suite concern around investment and capex and R&D and all that stuff, and that obviously has a negative impact, all told, on real growth. So I think all those things are coming together and going to come together, and I would not be surprised if the bank cut by one or two more, even if the bank says it's basically done here and doesn't do anything in December. I think the bank will do one or two more in the first half of the year. The market is really not pricing it. When I looked just before we started the podcast, the market really only has another 7 or 8 basis points priced by the bank in total. So basically 30%, 35% of one more cut, which is a little bit of a gap between where I am and where the market is. So there's a lot of interesting things I think to come out of the bank here for the next quarter or two, depending on how the domestic economy evolves.
So you have a bit of out of consensus view on where the short-term path of Canadian rates is going compared to market. Is inflation? How does inflation enter your picture, and what's your expectation for inflation within Canada?
I'll start with the 10% announcement that I'm sure everybody's heard. So just given where we are today on Wednesday the 29th, so about last week there was this concern over the 10% with the advertisement from Ford talking about tariffs and quoting Reagan, former President Reagan, and obviously Trump was not thrilled with that. So there might be it's still I think a little bit TBD, but the assumption I think is 10%, an additional 10% percentage points on non-USMCA goods, which is around 15% of goods that go to the US. So probably worth another 0.5% on the tariff rate, kind of going from around 6 to 6.5% from
Okay.
some of the work that I've seen. So I mean, it's not nothing. I don't want to minimize it, but it's certainly not a big concern. And I say all that because the bank, I think, re-engage the rate easing cycle after stopping, I thought, a little prematurely earlier in the year, but re-engaging the rate easing cycle after the reciprocal tariffs were taken off by Carney back. I think it was late August or early September. I can't remember when. But when that happened, the bank had been concerned around core inflation being a little bit sticky around 3 with upside risks. And the bank believed that once the reciprocal tariffs got taken off by Carney, that the risk to particularly core inflation had significantly declined. And so that I think not entirely, but was it one of the key metrics as to why the bank re-engaged in its rate easing cycle and obviously cut in September and cut again today. And so I think that the bank thinks that core inflation is still relatively tame and headline inflation has been also relatively tame, although I would note that oil prices have been moving higher, and that is a very, very good correlation with gasoline prices and headline inflation in Canada. Obviously, is very tied to the price of the pump. So there is that happening as well. But I think overall, if we kind of pare back and say, the bank's concern over inflation 6 months ago versus now, I'd say it's significantly less concerned about upside inflation risks now than it was 6 months ago. I also think, and maybe the last point on this is that I think the bank's more concerned about the economic outlook now than it was 6 months ago. And the bank believes that if aggregate demand is slowing, then that should have a negative impact on inflation, i.e., inflation should slow. And so I think there's that also happening from more an organic economic side as well. And again, going back to that zero point 0.6 and zero point 0.7 percentage point takeaway for this year and next year for real GDP estimates by the bank, that would also, I think, feed into the factor for the bank that, inflation is probably not a concern. So I don't think inflation is going to be a significant issue for the bank if it decides it needs to cut rates going forward. I don't think it's quite there yet, but I think it'll get there.
Great. Why don't we turn to the portfolios? So, based on what you've sort of walked through today, give me some of the ideas of what you're doing in the portfolios and just general trades that you're conducting there.
So there's a few things going on. It's a challenging time for sure. I think maybe a couple things on the macro side. One, we've reduced most of this US Canada spread trade that we've talked about a lot this year. And we have a little bit of risk on with that in our core plus portfolios, but in most of our other portfolios, we've exited that risk. Similarly, exited a lot of the risk around the US Germany spread trade as well. Some of that is because we are looking for US rates to head higher. So we want to be somewhat short duration in the US. And I think today's Fed action probably helps to at least solidify that in the short term. And we'll have a think about it and a talk about whether we have the right position sizing for that going forward. But I think it's probably good that we're out of those kind of spread trades at this point. When I think about just North American fixed income, very simplistically, sovereign fixed income, and I think about Canada, US, short end, long end, so kind of 4 points, right? Those four things, very broadly, very simplistically. Given what I've said about the Bank of Canada over the last couple of minutes, if I were to pick one of the 4 points where I've got the most confidence, I think the most confidence I have is being long the front end of the Canadian curve. I think,
Okay.
if the market is clearly not pricing what I think is going to happen by the Bank
Hmm.
of Canada, and so those kind of 2, 3, maybe 5 year notes on the Bank of Canada side, the rates should come lower, so prices higher, yields lower. So we like those kind of trades, or at least from an expected value perspective. Where do I have most confidence in kind of the again, very simplistically, those 4 points? I think that's where I have the most confidence at this point. Again, with today's Fed news, want to look and think about that a little bit more and see what the follow through is, particularly with some of these systematic and CTA accounts. This broad 4 to 420 range in 10-year treasuries, which is kind of, as I call it, the benchmark of benchmarks. And even within that, 405 to 418 was the real range, and then call it 4 to 420 in the round. We'll see what happens here with the close today, tomorrow, and the Friday close, which is the weekly close, obviously. But if we close on the weekly above 405 in 10-year treasuries, I think we're going to see some selling from some of the algos and systematic accounts. And from a short term perspective, that might not be very good for duration, i.e., selling duration, prices lower, yields higher. And so that would be kind of in line with the move that we've been looking for. And to be fair, wasn't looking our way when 10-year yields were moving below 4 and traded, I think, 394 intraday a few days ago. But again, today may have reset that a bit. The price action here, I think, will be really telling. So I think, when I look at fixed income trades, I think that's probably the most interesting one. The Canada short term, the long short term Canada trade, I think, is probably the one I have the most confidence in. And let's see where the Friday closes this week on long end treasuries. And maybe just quick on currencies. We've been long dollar Canada from a tactical perspective, so long US dollars and short Canadian dollars here. And that's worked for a bit, although it's climbed back a little bit over the last couple of days. Again, one would expect all other things equal, and there are many things that'll drive, but if the bank ends up cutting a lot more than the market expects, on the margin, that should not be particularly constructive for the Canadian dollar. And I would say if it's happening for the rationale that I expect it to, i.e., a deterioration in the domestic economic situation, that's probably also not great for the Canadian dollar. So we still have this tactical long U.S. Short Canadian dollar trade, which I think is important. We do have a fair bit of risk in emerging market trades, and I think with what's happened today with the Fed, that requires a bit of a relook, particularly for the low yielders. The high yielders, I'm not overly concerned about because the coupon we're clipping is pretty strong, pretty high. But the back of the envelope view is or idea is very simplistically, if U.S. rates are heading lower and the U.S. dollar is heading lower, then it's generally good for carry as a global thematic,
Right.
and it's good for emerging markets. And if, given what we had today with the Fed, like we talked about, if U.S. rates are going to start doing a 180 and heading higher, and the dollar is significantly bid, you need to probably think about kind of EM exposure from that perspective. So that'll be something that we look at. But the EM trades have done quite well for us this year, like Brazil, Max, a little bit of Peru. We were in Indonesia, now out. South Africa, which we've now hedged from a currency perspective. So those are all interesting trades and have their own, of course, idiosyncratic risks. But that'll be something that I think we're going to be looking at here, given some of the news from earlier today.
Well, Dustin, thanks so much for walking us through both the Bank of Canada and Fed reaction. I learned a lot. Appreciate you taking the time.
Thanks very much. Always great to chat.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may be associated with mutual fund investments. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.